So, welcome to the Monkey Stock Club. For those who are new at this channel, my name is Monkey B. I love to go out there and finding some nice stocks just for you. So all you have to do is just watching this video and decide if the following stock could be something for your portfolio. It doesn't get much easier than that. In return to that, please feel free to hit the subscribe button below and become part of the Monkey Stock Club family so you will never miss a video again. Please be aware that everything I say here is just my opinion, as I'm not a professional investment advisor. As you can see, I'm just a monkey, but nevertheless, I love to analyze stocks just for you. So let's stick around and discuss some numbers now. So to analyzing the stock, I use the high growth investing strategy. It consists of 6 KPIs. For every KPI you can get 0 up to 3 points. So in total, a stock can get a maximum of 18 points, and this indicates a high growth stock. So today we're going to discuss HEXO versus AURORA stock. We will do a comparison between both companies, so that's very exciting. Please watch the entire video, because I think at the end of this video you will see very nice and interesting information about both companies, also the comparison, and at the end I will also award one winner of both companies. So I will do my best today to go through all the KPIs. So first of all, we will do a high growth investing analysis with the 6 KPIs. Afterwards, we will do also for both companies a quantitative analysis strategy with 6 KPIs as well. And at the end of this video, and that's quite interesting, we will do also an analysis of the fair value of both companies. And then one winner will be awarded. Drop also the like button for the YouTube algorithm. That would help. So let's get started. To be honest, everybody is telling you just take a look into Yahoo Finance and you will see all the figures, all the data, and just analyze it and do the ratios and calculating the KPIs. To be honest, from my point of view, most of the people are getting crazy when they see all these figures. So don't be afraid, because I will do my best to show you my results, and all you have to do is just watching this video and then decide if both of these stocks could be something for you. So, HEXO Corporation. First of all, we will calculate the enterprise value divided by the sales. Within the next following slide decks, I will also explain what these 6 KPIs meaning in terms of the value. But here the overall results, how I calculate these figures. So the enterprise value divided by the sales, 3.69. It's very easy because you can see these value within Yahoo Finance as a result already for HEXO. So 3.69. The cross margin minus 72%, as this is the ratio of the gross profit divided by the total revenue. Then the rule of 40 score trailing 12 months. This is minus 142, as we use the EBITDA divided by the revenue. Then the next one, the 5th KPI, is the debit ratio. Here we use the total debit of the last quarter divided by the stock equity. And last but not least, one very interesting and important KPI for the high growth investing strategy is the PEG trailing 12 months. So you use the price per earnings divided by the profit growth. So we have an average of minus 14.4 PE ratio, and divided by the profit growth of around about 80% roundabout currently. We have unfortunately not available, as we have a negative value. So next one, so here the overall result for the high growth investing analysis. Here below we do the quantitative analysis strategy, so the return on equity, EBIT margin, equity ratio last year, the PE ratio 5 years, current PE ratio, and the profit growth. Also in this case we will explain what every KPI means under these circumstances and for the company. But here just quickly, here you can see the return on equity within Yahoo Finance, so we can write it down here, minus 81%. The EBIT margin is the ratio of EBIT by revenue. So you can use here the EBIT and revenue minus 177%. The equity ratio, we use the equity divided by the total cap, 88%, as you can see here, so a good ratio. The PE ratio within the last 5 years, so this is the average EPS within the last 5 years of minus 0.35. So if you if you take the current share price divided it by the average of the EPS, then you will get minus 2.1 as a ratio. The current PE ratio minus 14%, as this is the ratio of the share price divided by the current EPS. And last but not least, the profit growth for HEXO Corporation. So this in a short term, this shows you where all these data is coming from. So now we have for HEXO in total 12 KPIs. So 6 for the high growth investing analysis and 6 for the quantitative analysis strategy. The next one is the AURORA cannabis stock. So we will do the same as already explained and mentioned. I just go quickly through the final figures then. You will find everything also in Yahoo Finance. So for the EV divided by sales, 5.8, the cross margin minus 18.7, the rule of 40 minus 176, the sales growth trailing 12 months minus 8.8%, the debit ratio last quarter divided by the equity last quarter 0.17, and the PEG, so the PE trailing 12 months that we can see here, 33 divided by the profit growth trailing 12 months of 55%, so we end up at 0.6. Next one, the quantitative analysis strategy, return on equity, so the net income divided by the equity minus 103, as you can see here. Then the EBIT margin minus 115. So also, yeah, what could worries every investor is that if we take a look, that's an additional information just beside trailing 12 months. So if we see the trailing 12 months total revenue of 273 and the current EBIT of minus 3,446, that's really a bad ratio in terms of the EBIT margin. So this value is from the last year, and this is the trailing 12 months currently. So not such a good sign. For the equity ratio last year, 80% roundabout. The PE ratio 5 years minus 0.61. The current PE ratio, as we can see here also in Yahoo Finance, 33, and the profit growth finally roundabout 55%. So now we collected all the data, and now we can do the very nice and interesting comparison between both companies. So we will go through every KPI here, through the 6 KPIs for the high growth investing analysis to analyze both stocks, HEXO and AURORA, if they are in high growth stock. They can achieve in total 18 points for every KPI, so 3 points for each KPI. And for the first one, the enterprise value divided by sales. So in general, the enterprise value gives you as a measure of the value of a company regardless of its financing, and it could give you an important ratio for estimating the valuation of a fast-growing but still loss-making technology company. So both companies are getting 3 points as we are below 8. So both companies are having good ratio in terms of the estimating fast-growing company. Yeah, so HEXO is a little bit below AURORA, but nevertheless for both companies 3 points. Next one, the cross margin provides us a good indication of the profitability of a business model, and the higher the percentage, the more money a company has available for sales, marketing, and other stuff, developing new products, for example. So as you can see, HEXO has a minus 72 and AURORA minus 18.7. So both companies haven't got any additional money to doing some other stuffs like sales, marketing, and research and developing new stuff. As HEXO is doing a little bit worse than AURORA, but nevertheless both companies are getting 0 points as they are far below 50%. Next one, the rule of 40. So the rule of 40 is a simple key figure to assessing the efficiency of a company's growth and the quality of its business model. And the higher the value, the better the business model is, and everything above 40 could be considered as an attractive value. So as you can see, both companies are highly in a negative value, minus 140, minus 176. both below 40, 0 points. Next one, the sales growth trailing 12 months. For HEXO, we have a sales growth of 67%, as we have for Aurora minus 8.8 trailing 12 months. So in this case, HEXO gets 3 additional points as they are above 40. So HEXO is now at 6 points, as Aurora is still at 3 points. Next one, the debit ratio. So in this case, both companies are getting 3 points as they are below 0.5. So debit ratio less than 1 indicates a low debit, while a debit bigger than 2 indicates possible risk in terms of the financing and the debit. So both companies has a very nice debit ratio. So 3 points for Aurora as well as for HEXO. So HEXO has currently 9 points, as Aurora has 6 points. And last but not least, for the high growth investing analysis, the PEG. So this is one of the most important key figure for the assessment of an already profitable growth stock. And if the ratio is between 0 and 1, as Peter Lunch already mentioned, then we have an undervalued stock. And here in this case, for Aurora, we have 0.6, as we have the current PE trailing 12 months of 33 and a profit growth of 55, so 0.6. So 3 additional points for Aurora, as we have not available for HEXO, as we have a PE trailing 12 months of minus 14 divided by 80% profit growth, so negative NA. Unfortunately, not further points. So in a lump sum, both companies are getting 9 points out of 18. So quite nice. Both companies are high growth stocks, and they could be very comparable and are, let's say, on the same level. Next one is the quantitative analysis strategy. So first of all, the return on equity. This indicates how the equity of a company has earned interest during a financial period, and a shareholder can see from the return on equity how profitable his investment in the company is. So minus 81%, minus 103. So not so much to say. Worse figures in terms of the return on equity. In the quantitative analysis, you can get 1 point, 0 points, or also 1 minus point. So in this case, as we are below 10% return on equity, we got in both cases minus 1 point. Next one is the EBIT margin. So the EBIT divided by the revenue. And higher EBIT margin are a quality criteria for the investment risk. So the higher the EBIT margin, the easier is to manage declining sales, and can save us for big troubles. Minus 177, minus 115. So both companies are doing bad. Both companies are getting further additional minus points. So here we have the equity ratio last year, 88% and 80%. So here we got our first points for both companies, as both companies are highly above 25% equity ratio. And yeah, the equity ratio can provide information about the credit rating of a company. And here the first points for both companies for the equity ratio, and 2 minus points. So overall we are currently at 1 minus point in a sum. Next one is the PE ratio 5 years, so minus 2, minus 0.6. Both values are negative, so below 0. So we got 1 additional minus point for both companies. And the PE ratio 5 years indicates after how many years you have double your stake. So assuming that the profit remains constant. So in this case, not available, as we have minus and minus or negative value of the PE ratio 5 years. The current PE ratio for HEXO minus 14 and for Aurora 33, as we are above 16 for Aurora and in a negative area for HEXO. We have in both examples an additional minus point. So, and last but not least, the profit growth. We have a profit growth of around about 80% for HEXO and for Aurora 55 roundabout. So for every company, or for both companies, one additional plus point as we are above 5% profit growth. So overall, and that's quite funny and interesting, also in terms of the quantitative analysis strategy, both companies are ending up at the same value of -2. So they've got 2 positive points and 4 negative points, both companies. Also they got both positive points in the same area, so in the equity ratio as well as in the profit growth. And in all the other KPIs, they are doing quite bad, and that is why they got the minus points. And finally, the overview of the high growth investing score of 9 points out of 18. So they are comparable. Also, the maximum of the quantitative score of 6. They are in a sum by -2, both companies. And now, finally, the question of the fair value. So we are using the Peter Lynch formula, the EPS multiplied by the profit growth. And for HEXO stock, we have a prediction for the EPS for the next fiscal year. So as we are currently in 2021 for this fiscal year, we have an estimation of minus 0.01. And for this ending fiscal year, minus 0.05. So if we compare those two figures, then we would end up at around about 80% profit growth, as I mentioned in the slide deck before. But what I like more is to take a look into the EPS 4 years ago. So in 2018, we have minus 0.13, and compared to the estimation of minus 0.01 US dollar, we would have then an average profit growth of 23%, multiplied by minus 0.01, not available, and the current price is 0.72. The same situation is for Aurora, as we have an estimation for this fiscal year of minus 1.1 US dollar, and for the next fiscal year 0.5 minus value. So we have also a profit growth of around about 55, as I mentioned before. But if we take a look into the EPS of 2018 of 1.5 and compare it to the estimation of the next fiscal year, then we would end up as an average profit growth of minus 130. So here we already see a difference between both companies, as HEXO is doing better in terms of the average of profit growth within the last years. And Aurora is doing quite bad, as they had presented a very nice result in 2018 and ending up in an estimation of minus 0.5 US dollar for the next fiscal year. Current price is 7.13 US dollar. So yeah, that's the result of the fair price. But nevertheless, what I would like to do to give you an idea and to give you also an explanation why I would say that HEXO is the winner. From my point of view, as both companies are having the overall final result, or let's say the comparable final result in both analysis. Nevertheless, I would say HEXO is the winner due to the fact that if we do the following scenario, what I suggest is, okay, what would happen if HEXO would present us in the next fiscal year a better result than the minus 0.01 US dollar? So for example, just conservative 0.05 EPS for 2022. That would mean, if we compare this to the EPS in 2018, that we have an average profit growth of 35%. Multiply by 5 cents, then we would end up at 1.75 US dollar per share as a fair value. Compared to the current price, we would talk about a profit growth, or let's say in growth in terms of the share price of 243%. And if we do the same scenario for Aurora, here we have an estimation of minus 0.5 US dollar. So here I assuming a really, let's say, better result than in the case of HEXO of 50 cent as an EPS for 2022. Then, unfortunately, we would still talk about a negative profit growth in average within the last 4 years, as we had in 2018 1.48 compared to a result of 50 cent. Then we would still end up at not available. the potential of HEXO is above Aurora, and if this will be the case, then they will be, from my point of view, a huge development in terms of the share price. So yeah, that's my overall assumption. I really hope that you enjoyed this video. I really like the comparison format of this video, and I got also nice feedbacks from my previous video comparing two solar stocks. So I think this could be also very nice for further videos. If you like this video, please drop the like button for the YouTube algorithm. That would help me. And I would really appreciate if you also hit the subscribe button and become part of the Monkey Stock Club family. And I will keep you updated and inform you about nice comparisons and also nice investment opportunities, and also